What are even the products that we have in the market right now that government can actually tap into before we begin to look at the products we could possibly develop?
Okay, thank you very much, Chimese. Investment bankers are very exotic people. They tell you different kind of names, but everything boils down to two categories: debt, right, and equities, right. There could be various infrastructure bond, general obligation bond, all sorts of names, but those ones are debt. And when you're looking at infrastructure projects, these are projects that must have very high debt carrying capacity, because you're going to be having the equity rate, the debt equity ratio very, very high. A lot of debt will be required, and we have sponsors that will throw in part of their development finance and also part of the sweat equity, and also some catalyst funding. But the key thing now is, okay, how do you structure this particular kind of debt? It depends on every infrastructure. There's no one size fits all. If you are doing a seaport project, for instance, you'll be looking at what does the government allow you to charge, the level of throughput you'll be charging. So that enables you to be able to say maybe that would be a revenue bond, or whether you need a straight sovereign guarantee bond, right? And so I can't sit here and say this is a particular one that's a fits all, but I'll just say, look, debts, different kind of debt structures can come in, and there are thousands of those.
The federal government has always used the sovereign bonds to, raise money.
Yeah, but you see, that is not the most efficient way.
Okay.
To be frank, and because when you go and raise bond, and you now it goes into the national budget before it now gets to be appropriated again. The best way for me is to issue bonds directly for each project. Set up an SPV for a project, let the project itself raise the money, but the federal government is now providing guarantee to that SPV. Then everybody is now aware that Lagos Ibadan Expressway, Old Co Limited, which is owned by the federal government of Nigeria 100%, has raised a bond of $4 billion or $1 billion to do the road. And we can see that the money went in and is being applied for that road. Not the federal government raising money, it goes in the federal budget now allocate for the first 2 years, it gets stopped.
Okay.
Right.
Now,
So,
what about there's one they call the diaspora bond, the sovereign bond?
yeah, these are variants of debt instruments. Like I said, the diaspora bond, you're just looking at at people, Nigerians living abroad, that also want to have a part in the country's development by saying, okay, let me invest part of my hard-earned money in the country, provided is guaranteed by the federal government that I'll be paid back, and I want to then with that I'm contributing to the development of my country. That is attracting money from your natives that are outside of your country. Is still a kind of debt instrument.
Okay. Now, you talked about equity.
Yes, equity in the equity space, you could have different kinds of structures there, and between the debt and equity, there's always what we call the quasi-equity, which is not really a debt instrument and not really an equity instrument. It has features, but depending on the way you structure it, it could tilt more towards debt or towards equity, right? So that's why you have the convertibles, and that is where the foreign participants really like. They can come in as a convertible debt in the first 2-3 years when it's risky. Then once they see that the project is stabilized, the cash flows are okay, then they have the option to convert to equity, because equity gives them the upside risk. So the cash flow of every project, sorry to be going into very technical things,
That's okay.
but see, that is the only way I can explain. The cash flow of every project, the peculiarities surrounding the regulatory framework, right, and the market potential of you attracting money from the market, I mean the sales proceeds from the market, the collection from the toll roads, all these things are the things that will determine the way you structure, whether you're going to have more of debt than more of quasi-equity, and whether you're going to structure the quasi-equity to tilt more towards debt or towards equity, everything will be figured out.
All right, all this basically will revolve around the capital market, I suppose. So whose responsibility is it to really structure some of these debt or equity that you're talking about?
Yeah, that is the responsibility of the investment banks, and that's where people like Morgan Capital, my firm, come into play. And we have a regulator, which is Securities and Exchange Commission, that will regulate all the things to ensure that everything falls in line with the regulations and the standards. And we also, if the instruments will be listed on the stock exchange, it has the Nigeria Stock Exchange or any other stock exchange in Nigeria. We also have to be aware, and you have to go through their own, their own procedures also. But the beauty of the capital market is that it also provides liquidity, right? Especially getting listed, it enables anybody that that owes a bond to be able to sell even before the end of the tenure. If it's a bond of 20 years you are holding, you could sell after 2 years, right? Or you may buy more, depending. It's free entry, free exit, provided you can meet the price.
All right. Now, there is also the issue of bank debt. How do you differentiate bank debt with bonds? What are the pros and the cons in using them?
Yeah,
those instruments as a means of funding infrastructure.
Number one, it's a mismatch, right? Bank debts are shorter. You must understand the way banks get their funding. They get their funding from deposit. That's what they're called, deposit money banks. And deposits are normally short-term kind of instruments. So a bank debt is a bilateral debt, bilateral obligation between the bank and the borrower, and it's normally for maybe 1 or 2 years. But you're talking about 20-year projects, and the banks will not be able to do that. And if you look at most of the offer letters Nigerian banks normally give, they'll tell you that they can withdraw funding, additional funding to you at any time. Right, so that's why you don't do a 20-year project talking to the bank. The banks may assist in providing some of the less core funding surrounding the project, but not the core funding.
Okay, so government should just not rely on them.
Yeah, it's not as if they shouldn't rely on them. They can invest in the bonds, right? But they can't give their it shouldn't be as loans, because I do not expect any bank to give like a 20-year loan or a 10-year loan, but a bank may decide to invest in a 10-year money. I mean, in a 10-year bond, right? So lending out to a 10-year bond is like investing, right? But not giving a bilateral loan of 1 year, 2 year for a project, even from the angle of the federal government. You want to build a road for over 20 years, and you're not taking money from a bank over for 2 years. It's a mismatch. You have a tenure mismatch there.
Okay. Aside from the equity and the debt instrument that you have,
bonds,
that's the bonds that you've mentioned. Are there other tools that can be developed really that are not there, that you think, being in the market for so many years, are there other tools you think, this can actually help the government?
Yeah, the other thing the government can do, if proper structure can be put in place, is to use what you have to get what you want. We are majorly hydrocarbon producing. We have crude, gas. We could really do like a crude for equity swap, right? Get companies, international companies that are very serious to enter into a for crude sale, right? And for that, they would invest in a project, but the project must be well singled out. It's just like ship financing, where you have every ship like a different limited liability company. You have Lagos Ibadan Express Road, you have Maiduguri Kano Road, and each of the money being done in that swap will go into each of those projects, and everybody can see the transparency. There are people that would also approve or monitor the process. It shouldn't be left to civil servants alone, right? We are not saying civil servants are bad, but we know the history which we've been through. Get companies that would attest to the quality and to the time of completion of this project in line with the agreement for the crude swap. for instance. Yeah.
Okay, there's also the issue of credit enhancement. What's that?
Credit enhancement is mainly when you are taking a bond, right, and you want someone to help you enhance the or improve the kind of ratings it could have. That's why I said most bond in Nigeria, most infrastructure deals are coming out of Nigeria. You see a lot of sovereign guarantee. There are various ways in which credit enhancement can come, but the major one is sovereign guarantee. The federal government, if you're issuing a bond to do Kaduna Lokoja Road or Abuja Lokoja Road, for instance, the government can give a guarantee on that bond. That enhances the credit. The other ways of doing it is to get a supranational, like a World Bank, to give like political risk guarantee. And what that does is, for instance, if a government comes in play, another government comes in and says, okay, we want to cancel that project, the World Bank steps in and negotiates, makes things a lot more easier for the project sponsor. And there are other kinds of guarantees that that are also being put in, but everything will not depend on each kind of project.
All right. So, generally, are you optimistic that government is on track with its national integrated infrastructure policy, and are you optimistic that we are going to achieve it, come sunshine, come rain?
I'm an investment banker. I'm always inclined towards being optimistic, but I also like to be realistic. It's like I think we've started quite well, at least understanding what our problems are, and also creating a plan. But the other issue you have to look at is just like a child coming to meet you and says he wants to become an engineer, and you went through his, what he's studying in school, or you ask him, he's not studying physics, he's not studying mathematics, he's studying the arts. Then the question now becomes, how do you become an engineer in 20 years where you're not studying physics now?
All right. Thank you very much. It's been wonderful speaking with you. Well, I've been talking with Ayoleke Adu. He is the Managing Director and Chief Executive Officer, Morgan Capital Securities Limited. I will be looking at variable ways through which government can raise funds for infrastructure development through the capital market. Well, it's on that note we draw the curtain on this midweek edition of the program. Tomorrow is another day despite the holiday, and don't forget to join us. Until then, enjoy your day.